Hey friends, welcome back. I'm super excited because today we're diving into a really interesting topic that I think you'll love. Investing in the stock market might feel a bit overwhelming if you're just starting out, but trust me, it's an awesome way to grow your wealth over time. Let's dive into it. Ready to dive into investing in 2025? Here's your fun guide to making millions from stocks. Investing in the stock market is all about buying pieces of companies to grow your money. At its core, investing in the stock market means buying tiny pieces of ownership in public companies. These pieces are called shares or stocks. You buy a share, you become a shareholder, and essentially own a minuscule fraction of that company. Companies issue shares to raise money to grow their business, develop new products, expand operations, or pay off debts. Once these shares hit the market during an initial public offering, or IPO for short, they start changing hands among investors on stock exchanges like the stock exchange. It's pretty exciting stuff. Investing. Why is it so important for us? You might be thinking, why not just stash my cash in a bank? Well, here's the deal. Investing, especially in stocks, is super important. Beat inflation, the cost of living generally increases over time. If your money just sits in a savings account, its purchasing power erodes. Investing aims to grow your money at a rate higher than inflation, so you can maintain or even increase your purchasing power in the future. Wealth creation, historically, the stock market has been one of the most effective ways to build substantial wealth over the long term. While there are ups and downs, the overall trend has been upward. Achieve financial goals, whether it's saving for retirement, a down payment on a house, your child's education, or starting a business. Investing can help you reach these significant financial milestones faster. Compounding, this is often called the eighth wonder of the world. When your investments earn returns, and those returns then earn their own returns, your money grows exponentially over time. The earlier you start, the more powerful compounding becomes. Passive income dividends. Some companies share a portion of their profits with shareholders in the form of regular cash payments called dividends. This can provide a stream of passive income. Investing in the stock market has some cool perks we should totally chat about. Potential for high returns compared to other asset classes like bonds or savings accounts. Stocks historically offer higher long-term returns. Liquidity. Most stocks traded on major exchanges are highly liquid, meaning you can easily buy or sell them for cash quickly. Ownership and influence. As a shareholder, you have a small ownership stake and, with common shares, often have voting rights on company matters. Diversification opportunities. You can invest in a wide range of companies across different industries, sectors, and even countries, allowing you to spread your risk. Accessibility with online brokerage accounts. It's easier than ever to start investing, often with low minimums. So here's the scoop on how it works, especially if you're a new investor. Educate yourself before you put any money in. Learn the basics. Understand what stocks are, different types of investments, individual stocks, mutual funds, ETFs, and common investing terms. Check out our playlist for some really cool videos that dive into these details. Define your goals and risk tolerance. Goals. So, what are you really investing for? Is it that dream retirement in 30 years? Or maybe snagging a cozy house in just 5 years? Your timeline totally shapes your investment choices, you know? Risk tolerance. How comfortable are you with the possibility of your investment losing value? Are you okay with short-term drops for potentially higher long-term gains? Or do you prefer more stability? First step is open an investment account. You're going to need a brokerage account if you want to dive into buying and selling stocks. These accounts are super easy to set up with online brokers like Fidelity, Charles Schwab, or Robinhood. It's pretty much like opening a bank account, you know? If you're diving into the Indian market, you absolutely need a demot account. Super handy for keeping your shares safe and sound in an electronic format. Easy peasy, right? You can also purchase mutual funds from a fund company like HDFC Fund website directly. Next step is fund your account. Transfer money from your bank account to your new brokerage account. Choose your investments, individual stocks, buying shares of a single company. This requires more research and carries higher risk if not diversified. Safer bet would be mutual funds or ETF mutual funds, a professionally managed portfolio of stocks from many different companies. You buy units of the fund, which then invests in many securities. This offers instant diversification. Exchange-traded funds, similar to mutual funds, but they trade on stock exchanges like individual stocks. Many ETFs track specific market indexes. ETFs are often a great starting point for new investors due to their diversification and low costs. Place your order through your broker's platform. You'll place an order to buy your chosen investment. Keep an eye on your investments, but don't sweat the small stuff. Check in regularly and rebalance your portfolio now and then to make sure it matches your goals and comfort level. Investing takes time. Don't expect fast cash. It's like planting a seed and expecting it to grow and give fruits. You could really see some amazing results if you put in a big lump sum, or even just small amounts regularly for 10 or 20 years. Let's dive into the risks involved and see what we really need to watch out for. Every investment carries risk, and the stock market is no exception. For new investors, understanding these risks is vital. Market risk: loss of principal. The most fundamental risk is that the overall stock market, or the value of your specific investments, could go down. You could lose some or even all of the money you invest. Volatility, price fluctuations, stock prices can go up and down significantly in short periods. This choppiness can be unnerving for new investors. Company-specific risk, business risk. An individual company you invest in might perform poorly due to bad management, declining sales, competition, or other internal issues causing its stock price to fall regardless of the broader market. Inflation risk. Even if your investments grow, if inflation is very high, your returns might not be enough to increase your actual purchasing power. Liquidity risk. While major stocks are liquid, some less popular or smaller company stocks might be harder to sell quickly without impacting their price. Interest rate risk. Changes in interest rates set by central banks can affect stock prices. Higher interest rates can make borrowing more expensive for companies and make bonds more attractive to investors, potentially diverting money from stocks. Economic systemic risk. Broad economic downturns, recessions, or global crises can impact the entire stock market, regardless of individual company performance. Psychological risk is a big deal. New investors often let their emotions take the wheel, buying high because they're feeling greedy and selling low out of fear. This roller coaster can really mess with your returns, you know? Time to dive into the key takeaways for new investors. Let's break it down. Start small. You don't need a lot of money to begin. Many brokers allow you to start with small amounts or even fractional shares. Thinking about small, steady investments? Check out mutual funds, balanced funds, or hybrid debt funds. They're a great way to start. If you're just starting out as an investor, kick things off early and with a small amount. And hey, don't expect to see results overnight. Patience is key. Invest for the long term. The stock market tends to reward patient, long-term investors. Don't expect to get rich overnight. Diversify. Don't put all your eggs in one basket. Invest across different companies and industries. Consider diversified funds like ETFs or mutual funds initially. Keep learning. The financial world is always evolving. Stay informed, but be wary of get-rich-quick schemes. Only invest what you can afford to lose and won't need soon. Make sure you have an emergency fund saved before you start investing in the stock market. You shouldn't invest money you might need in the next 3 to 5 years. Investing can be a rewarding journey. By understanding the basics, setting clear goals, and managing your risks, you can confidently embark on your investing path. You've probably seen those videos showing how long-term investments can really pay off, right? We're talking returns of 70% or even 100% over 10 to 20 years. If you want to dive deeper, hit that subscribe button and check out our playlist for more awesome details. If you're looking for tailored advice, definitely chat with a financial advisor to meet your needs. Our channel is all about sharing financial awareness and helping you learn more. What did you think of this story? Keep watching because there's so much more to come. Thanks for tuning in. Don't forget to like and subscribe. Catch you soon with more fun videos.